I expect gold to go to 8,000. That's just matching the old highs, though. That's not even abnormal. That's like saying, oh, I did it again. How about we go a lot further than that? Don't be surprised. Like 20,000, whatever. So silver's been outperforming gold for the last half a dozen months or so, gaining. Well, heck, right now you're at 1.27% as we speak. If it went to 2%, just a norm, well, that's a huge move. That's almost a doubling of the price of silver in relation to gold. I expect silver maybe be $200 that fast. And people are looking for normality, like, oh, we go up 4 steps and pull back 2, go up 3, pull back 1, all that nonsense. The norms will be shattered, and you'll go into a new reality.
The structure forming beneath gold and silver is no longer behaving like a conventional bull market. Momentum is tightening, volatility is compressing, and historical resistance levels are being approached with extreme internal strength. This is the type of environment where markets transition from steady climbs into rapid repricings, especially when financial stress, liquidity expansion, and sovereign debt pressures simultaneously collide. What's happening now is the early stage of that shift. Michaeloliver, a leading voice in momentum analysis, notes that the current advance has only reached half the magnitude of previous major bull markets, despite today's macroeconomic conditions being far more explosive. His work highlights that when metals reach certain momentum thresholds, levels now visible across gold and silver, the next phase is typically violent and fast. He suggests gold reaching $8,000 is simply matching historical peaks when adjusted for monetary expansion, with potential overshoot levels stretching toward $15,000 to $20,000 if external shocks accelerate. Silver's setup appears even more dramatic. The spread relationship between silver and gold is approaching a multi-year breakout that historically precedes parabolic moves. If that ceiling is cleared, silver could replicate past surges that saw prices double or triple within months, not years. In the face of current monetary erosion, a move toward $150 to $200 silver cannot be dismissed, and temporary overshoots well beyond those levels are possible during periods of peak panic or capital flight. Now, we present the clips from Michaeloliver's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Over that time, there have been 2 major bull markets. And if you measure from the bear low that preceded the bull market to the bull market peak, bear low to bull peak, both moves, one peaked in 1980, one peaked in 2011, were 8-fold moves. Not the same dollar amount, but the ratio move. The same dimensionality of price gain, 8-fold, bear low to bull high. We're only 4-fold. We started from a bear low at 1,050. Multiply it times 4, okay? You're a little bit better than half the dimension of those 2 prior bull markets, which were of different duration, by the way. One was about 3.5 years, one was about a decade, okay? So I'm not counting the years, I'm just saying how much did it move? And it moved under circumstances then that are by no means as dynamic pending as the ones we're sitting on right now. I expect gold to go to 8,000. That's just matching the old highs, though. That's not even abnormal. That's like saying, oh, I did it again. How about we go a lot further than that? Don't be surprised. Like 20,000, whatever. Again, it's going to depend not on so much the technical dynamics of gold when you do swing measurements or anything like that. It's going to be on these other factors that suddenly cascade into play. They're not evident right now to most people. All they're focused on is AI, But if all of a sudden other factors come into play, especially negative ones, hands go in the air, emotions occur, politics becomes dissembled, which it's already become. I mean, the 2 parties are fragmented internally, getting worse even on the GOP side's fragmenting. Suddenly, people don't have a sense of, it's 52-card pickup. And there's one thing they can rely on, like their granddad told them, keep those gold coins, those silver coins. Okay? Yeah. And all of a sudden, those monetary metals are, again, monetary metals. But as far as I'm concerned, just as the U.S. government and their central bank, just like the EU and Japan, don't control reality. So even if they set a price, I don't care. It doesn't mean it's going to stop there, okay? They don't fix price. They may try to. I mean, there's some solid arguments that they've been manipulating silver. We need to get onto that, too. And capped it off for the last 50 years. While copper and lead have quadrupled. I'll get into that in a second. And suddenly, I think silver is about to leave and overrun that attempt to control the price of silver. And we know some of the big banks have been manipulating silver. In fact, there's been a couple actual criminal convictions in that regard. But if you want to, we can get on to that next subject. And you've got the spread chart of silver versus gold. This only goes back to 2020. Okay, so 5 years. We know in early 2020 and to late 2020 and early 21, silver exploded in price. And therefore, the spread chart showing an ounce of silver divided into an ounce of gold was under 1% then. It was under 0.9%. Divide an ounce of silver, an ounce of gold. It shot up to over 1.5%. That's a huge percent gain. It's like buying a stock at under $9 and it goes over 15. Did it in like 6 months. These are weekly readings here, by the way, week to week. But then since 2021, when silver was over 1.5%, which is still dirt cheap historically, silver to gold, it eroded. Now, price of silver is going up since 2020. We know that. 2020 was 30. We're now, $52, 53. So it's gone up, but its performance versus gold has eroded, meaning it's not gone up as much as gold from that point to the current level. Now, you'll notice since about March of this year, that thing exploded back up again. So silver's been outperforming gold for the last half a dozen months or so, gaining. But there's a green line on that top chart, the spread chart. If you can clear that line, this spread breaks out, and that line goes back over 3 years. Ceiling, ceiling, ceiling. It's called what you call a base, okay? You break out over that, it's a fresh buy signal, meaning time to buy silver rather than gold. Doesn't mean gold's going down, just means silver's going to beat it. So if you have the combination of that first chart, gold breaking out versus the S&P, what it's telling you is you want to be in monetary metals, not the stock market bubble. This chart says you not only want to be in monetary metals, you want to be in silver as opposed to gold, because it's going to beat gold. I'm strongly of the assessment, that when that first chart breaks out, gold versus S&P, as I said, it's already broken out versus the broader stock market indices. Silver's going to break out versus gold. And already this spread chart doesn't show where it is right now. It's up. It's moving up toward that green line right now. This chart's a week or so old, and we know a lot has happened in the last week. So that's another spread I'd watch, because it's not only telling you monetary metals are a place to be, but now you really want to focus on silver. Now, where might it go? If you go back 50 years and measure the peak point of where silver was versus gold each of those years, what was the highest rate, percent level, ounce of silver? 20 of those 50 years, it was at 2%. No, some of those years weren't even bull years. In fact, the bull years, 1980, 2010, 11, silver was up to 3.5% and more, the price of gold. But just routinely, 2% is not uncommon, 20 out of 50 years. Well, heck, right now you're at 1.27% as we speak. If it went to 2%, just a norm, well, that's a huge move. That's almost a doubling of the price of silver in relation to gold. So anyway, this is an area where I'm mostly focused personally in my investments, and they're exposed at the end of each report. I disclaim what I own. All my emphasis is in silver, sometimes silver calls, silver miners. We're on the cusp of a major reality, a new reality for silver. And I'm arguing it's highly likely to happen. First off, if that spread chart I showed is silver versus gold with that ceiling goes back over 3 years. Boom, boom, boom. When you break out over that, same spread chart event occurred 5 months before silver reached $50 in 1980. It moved from the 20s, from the 15 level, I think it was. It's like a quadrupling in price of silver in 5 months. And the only technical we can find that said it's about to begin was not the bull trend in silver. It had already been going on. It had been going up for years. Suddenly it went electric. That spread broke out. 2010 and 11, silver had already been going up since 2000, 2001. And in 2010, in September, through April 2011, silver went up in that 7-month period, double and a half. Bam, the spread broke out first. That spread breaks out, we set the clock. And I'm arguing that probably in the next couple of quarters, remember the copper move and the lead move, and there's plenty of other markets that have done that. I expect silver maybe be $200. That fast. And people are looking for normality. Like, we go up 4 steps and pull back 2. Go up 3, pull back 1. All that nonsense. The norms will be shattered. And you'll go into a new reality. And yeah, you'll get a sell-off at some point, but it's likely to be in a reality that possibly even overshoots what a real price conversion of silver would be, factoring in the decay in the value of the money unit, the dollar. Not versus other currencies, but its real value, the quantity of dollars, the M2 chart, which is, goes up about 90% in supply every decade. Okay. And so being $200 might just remotely match the 1980 high. So, and I expect it to happen very quickly. And frankly, if you're not there, you're going to miss it. But don't use the normal tools. They won't work.
The long-term structure developing beneath gold is beginning to signal a significant shift in relative performance compared to the broader equity market. After nearly a decade of sideways movement, the gold to S&P ratio has repeatedly pressed against a central multi-year resistance zone, creating one of the clearest technical bases in modern market history. The consistency of these tests and the current position near the upper edge suggest that a major breakout is approaching, one that historically marks the start of a multi-year cycle in which capital rotates out of expensive equities and into hard assets. Once this ratio clears resistance, the message is simple. Gold becomes the superior asset class, while stocks enter a period of underperformance. Broader commodity indices are also beginning to turn higher, hinting that a new cycle may extend far beyond precious metals. With liquidity stress rising and central banks preparing to intervene again, the macro backdrop reinforces this shift. Let's get back to the interview.
Gold was collapsing in price also against the S&P. It was losing value to the S&P. And when gold bottomed in late 2015, that spread reached down to about 50%, that first little circle you see there. And at that point, you can go sideways for 10, 11 years now. And it's been above that level and below that level, but basically par to the S&P. In other words, it's, depending on the point in time you pick, it's doing better or a little bit worse than the S&P, but basically going sideways, okay? Meaning it's not really been as bad as people think. And it's not just recently that gold's firmed. It's at the upper end of the 11-year range right now. But this thing has built a technical base that is so clear it smacks you in the face. It's hit 1, 2, 3, 4 times as of April this year. You bumped that line, backed off again. You're back pressing at it right now. In fact, you're above it intra-month. This is monthly closes. So gold into the S&P. And you close the month where you are now. Divide gold into S&P. It's going to break out. What does that mean? It means that this is a fresh, massive technical base breakout. Treat it as a price chart. If you looked at this and saw it as a price chart, you say, oh boy, I'm going to get on board. And I'm going to buy. Well, this means buy gold, sell S&P. In fact, you want to go market neutral, buy gold, sell S&P. You put a spread on. But it's also telling you that gold is going to surge versus the S&P. Now, by the way, when we do this same chart, we didn't have it in this report, versus the Dow, or gold versus the New York Composite, both very broader indexes that aren't front-end loaded with a couple of AI stocks like the S&P is. Gold's already broken out. But when this guy breaks out, this spread breaks out, it's telling you as a major asset class shift is underway, it's commencing. Gold is now going to outperform the S&P. So if you invest over spans of time and want the better asset class, it's saying gold is going to lead the S&P now. It's the better place to be. And our assessment is, one, it's going to be the consequence of two things: gold going up and S&P going down. Okay. So this is our table pounding technical chart to nail you all. If you're in the stock market or the gold market or wherever you are, this is the most important breakout that's about to occur. And if it breaks out, which it will, this is too persistent, okay? It's saying, I just began. So if you think gold is old, it's just begun its major shift against the paper bubble, the U.S. stock market. Just began. It ain't going to end in 3 months. This is something going on for years. Don't think of gold as being at the end of something. It's just beginning when you measure it versus the U.S. stock market. And again, it's already broken out versus the Dow or the New York Composite. It's about to break out versus the S&P. So this is a very important investment grade technical chart. Some people look at other end. We like that one because it's well balanced. It's not so heavily overweighted in energy, for example. It's got metals, base metals, meats, grains, etc., sugar, things like that. It does not correlate to gold over time. Sometimes it does, sometimes it doesn't. In the late 1970s, it coattailed gold up to the 1980 peak. But it began a whole year after gold had already turned up from a 1976 low. Commodities didn't turn up till 77. And they didn't match the dimension of the gold move, but they followed it. But if you'll look, for example, from 2015, commodities were a little low. Gold was making its bear low then, late 2015. Gold doubled between 2015 and 2020. In fact, it went from 1,050 to over 2,000, okay? During that same time, the Bloomberg Commodity Index ratcheted lower. Didn't collapse, just kept going down. So it didn't correlate to gold. Oil correlates well to the Bloomberg. All the basic commodities you can think of correlate well. Silver does not correlate well to the Bloomberg and commodities. Commodities can have a downward trend and silver go up with gold. Silver correlates to gold. It may lag or lead, but it will be in the same direction. So to make a mistake of thinking if commodities go down, that could hurt silver, no. The correlation doesn't exist. There's very few times where you can find that linkage. But right now it looks like the Bloomberg, which is a very cheap category. It's for the last 2 years after the correction that occurred from the 2022 high when that war started, commodities peaked, okay? They didn't go up because of the war, they peaked then. They dropped back to 100. Well, heck, the high in the Bloomberg Commodity Index in 2008 was 238. Right now we're trading at about 110. We've recently broken out. The October close for us, which was above a key level for us, which is in the 106s, said the Bloomberg is waking up, it's going to go up again. Right now, oil is a laggard, a weak component within the Bloomberg. Copper strong, grains are starting to assert themselves via our momentum metrics, meats are strong, base metals are strong. Oil will follow the Bloomberg. Right now, it's probably in a slingshot position where you're right, it's cheap. In fact, I understand that most companies that produce it really aren't hedging here. They think it'd be foolish to hedge the oil production here at these price levels. We've got some trigger numbers on crude in the 63, 64 range and a big trigger number at 68. Well, right now we're under 60. But it won't take a lot to get up 63, 64. And if you do, watch it because oil could then quickly join the upturn that's already underway in the Bloomberg. But when you go back and look at history, like measure Bloomberg versus S&P, it's like, is it going to zero? No, of course not. It's gone sideways for the last couple of years versus the S&P. So we think it's collapsed since, for example, its high relationship to the S&P. It peaked in 2007 or 2008. Commodities did peak and went down, and they went down more than the S&P because the S&P was about to bottom in 2009. So the S&P went up and Bloomberg went down, but the relationship between the commodity category and the U.S. stock market has probably never been so cheap. And from an investment category perspective, we think that spread is basing, meaning it's not going to lose value to the S&P anymore, and likely about to turn up. So from a, let's call it a long-term investment point of view, it's time to start thinking about commodity-related stocks, which don't behave like the S&P. Mm-hmm. And it might be a great place to be for the next decade. Because we know one thing's going to happen. When that stock market breaks and the data points go dark, real dark, central bank's going to print like crazy. And they already announced, one of the Fed governor in New York said today, he didn't say the word print, but he says, we're going to start buying T-bonds, long-term debt market. Why? Because they're, quote, illiquid. meaning they ain't behaving the way the federal government wants them to behave. So they're going to artificially come in, create money, and buy T-bonds. Well, that's part of the river flow will increase again. This time, instead of going into the stock market, 2000, 2002, 2007, and 9, they pumped money like crazy, but it wouldn't stop the stock market bubbles from breaking. The money went elsewhere. And right now, I'd argue that the stock market's topping, as we argue it is, that when it does, the money flow will increase, but it will go into other things, gold and silver primarily, but also cheap commodities. I think they're a great investment category. Reality, in other words. Invest in dirt. Yeah. Okay? You could probably buy cow manure if you could store it and make more money than being in the S&P.
As the macro landscape shifts, the structure forming beneath both gold and silver is pointing toward an accelerating transition away from paper-based wealth. The persistent compression in spreads, the renewed strength in precious metals momentum, and the weakening posture of major equity indices all suggest that a significant realignment of capital is unfolding beneath the surface. This is no longer the slow, grinding pattern investors watched for years. This is the tightening coil that historically precedes a decisive move in monetary metals. With liquidity stress building, long-term yields threatening systemic stability, and central banks preparing to intervene once more, precious metals stand positioned to benefit from both defensive and offensive flows. Technical bases that took a decade to form are nearing resolution, and once the breakouts confirm, the rotation is likely to accelerate faster than most investors expect. Hard assets tend to respond with disproportionate strength when confidence in financial structures begins to fracture, and the current signals are aligning in that direction again. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.